Hey everybody, welcome back. I hope you all are doing very well. Today we'll be talking, moving forward and talking about the liquidity ratios, right? In previous videos we have covered profitability ratios. Now we'll move on to the liquidity ratio. Liquidity ratios basically tell you how how the company would be able to meet their liquidity or their short term basically obligations any if the company has, right? So in that, the first ratio which comes is called the current ratio. So current ratio is basically the ratio of current assets to the current liabilities. So what this ratio tells you is that whether the company has enough current assets to pay off its current liabilities, right? So if this ratio is greater than 1, then the company has sufficient current assets to pay its current liabilities. Ideally, this ratio, current ratio for a company, should be between 1.5 to 2, right? So this means that the company has good liquidity. And if it is very high, for example, if this ratio is greater than 5, then it would indicate that company is not utilizing its assets properly, right? Because a lot of current assets are there but liabilities are not that much. So this means that they are not able to convert their assets into sales. If I want to comment, I'll look at the other ratios which we talked about, in which assets were there, and ATO, asset turnover. I'll look at the asset turnover also if I want to comment on that. But anyways, talking about the current ratio only right now. So if it should be greater than, it should be around 1.5 to 2. That is a good ideal ratio. But if it is very high, it means that the assets are not being utilized properly. And if it is very low, right, it means that company won't be able to pay its current liabilities with their current assets, right? So it shouldn't be less than 1 basically, at any cost. But you see, why are we looking at this ratio? Because we want to comment that whether the company would be able to pay its liability, short term obligations, with whatever cash it has, or whatever current assets it has. But you see, in current assets we also include inventories, and we cannot convert inventories readily into cash, right? So for example, let's say the company goes bankrupt tomorrow. Bank won't be able to recover by selling off the inventories, right? Because it will need some time. We want to have a ratio from which I can comment directly whether the company has a good liquidity or not. For that, we use a ratio which is called quick ratio. This is also called asset test ratio. So what we do is, instead of current assets in the numerator, what we do is we subtract inventories from the current assets and then divide it by current liabilities. So once we remove the inventories, it gives us a true picture of how much assets are there which could be directly converted into cash to pay off its current liabilities, right? So if this ratio is greater than, greater than 1, it means that the company would be able to pay its short term liabilities. Thank you so much. Have a nice day. Please subscribe to our channel. Bye bye and take care.